I've predicted new lows in the first 6 months of this year. That remains true. Doesn't mean that we can't have a little rally here in the
Okay.
first 1 to 6 weeks of this year.
So Kelly, I'm going to pass it over to you to let us know that Happy New Year. Are we looking at a little bit of a rally this to start off the year? How far do you think that's going to go, and what do you see coming over the next few weeks?
Oh, thanks, Aaron, for the introduction, and hello, everybody, and Happy New Year once again. To your question right off the bat, here's where I feel the markets are looking right now. I think January is going to be choppy to the upside. Look for our AI portfolios to actually become a little bit aggressive in the short run, which means that we might be looking to buy into the broader market through the spider and maybe some of the ancillary stocks that are inside our new portfolios, which are reconstructed for aggressive, conservative, and moderate. The way it looks right now is the information is now over the next 7 weeks is going to be hinged, that the numbers are coming out are completely hinged to the way investors, which means really institutions at this point, will allocate money on their perception of what the Fed will do early on in February and later on in the year. Most participants expect that interest rates will go up again sometime in February by another 50 basis points. However, as seen in some of the Fed fund rate futures, the probability of that is decreasing. The first part of the year rally is to totally be expected, and that is portfolio managers reallocating, putting money to work in the very first few weeks of the year, regardless of what the information is. There is pent up money on the sidelines. However, it is looking to get into the market. That's why we see a rally. We may go along with it. There are certain signals in the AI that starts to look positive that might put us into the market, albeit scary as it seems. Should this be the case, we could see signals as early as Friday. Of course, that would be the 13th. Don't be superstitious, people, because those things, I don't believe in superstition, but it does look like there's a potential chance, should we have some kind of higher close tomorrow, that Flip may be going long into the market this coming Friday, which would represent the second week of the year, and maybe a potential move from the S&P sitting now at around I have it around 395 on the spider. Then it could look to go towards 410 all the way to as high as maybe 420, in which case Flip investors will be long the market. So that is the most material change, everybody, in the short run. However, should that be the case, don't look for your portfolios to remain long. It would be trade, and it would only hold on to that should we be able to hold support in the area that we are in now, which is about 395 to 400 on this spider. So that is the material thing. However, here is the but, the conjunction. We suspect mathematically that this will ultimately roll over as the data unfolds in February and March. So the data that should unfold in February and March will probably lend itself very likely to lower prices. Now, does that mean we just wait for that to occur? No. That is an expectation of data by most pundits and most of the market. Most of the market believes that over the first quarter to half a year that the market may slip into a recession. The behavior of the market is a totally different thing. And we respond to the math and the behavior of the market, not the expectation of the market. So even though the expectation of the data right now is lending itself towards further inflation, even though not as brisk, we see that the market data that comes out will likely lead to lower prices, but that will occur as this data comes out over the next 7 weeks which puts us towards the end of February. That being the case, I suspect that somewhere in the short run, we may get long the market, but don't look to hold it too long. Hopefully, there's something in the short run to get us into from around 400 area all the way up to 410 or 420, in which case the math would prevail to probably be out of the market, looking to take a slight gain in the market if possible on the data that might be coming out over the next 2 or 3 weeks. So short-term bullish, intermediate and long-term bearish is my point of view. The data is pointing towards short-term bullish, intermediate-term bullish, but long-term bearish. So we will play the data. The data does look starting to turn over and look positive. But remember, the data isn't out, and we are now just dealing with the emotions and the rebalancings of portfolios as money managers put money to work in the anticipation that this year will be a much better year than last. We suspect that the market will move between 320 on the downside all the way down to 3,000 on the S&P, and all the way up to is possibly 4,200 to 4,300 on the high side later in the year. So I think actually this is quite a turn from the last AI circle where we ended the year. The turn is that despite expectations of bearish information coming out, that doesn't mean that the short-term outlook has turned marginally to the positive side, mostly because of the early action of the year. And some of the data points are starting to show a reduction of inflation. I think some of us can see it in individual things. Certain kinds of prices for home builders have started to go down. Lumber costs are down. Copper prices are down. Those are things that are generally deflationary. And so those things have kind of radically moved over the last 2 weeks. We've also seen gold, on the contrary, kind of move all the way up towards $1,900 an ounce, expecting that bearish news. I expect gold in the short run to fall off and the market a bit further. Should it, we will end up getting in the market. But I do suspect somewhere by March or so, we will be far more defensive position and looking for the market to go south. So short-term bullish, let's look at it like that. The math will take care of everything if you're invested in smartfolios. I see crude oil, by the way, steadying here around $75 a barrel. However, if you notice, this is still, a low $100. It used to be $100 a barrel. We are down 25%. We have noticed deflation at the gas pump. I'm sure almost most people know that the average price right now in the U.S. is running around $3.10 to $3.10 a gallon, way down from $4.50 and as high as $5 or more in many states out west. We have seen moves in the crypto markets, by the way, are starting to steady as well. You might notice, even though the contagion of FTX remains. So the crypto markets are starting to stabilize. And hopefully, if they can stick around here for a few more months, we may start to see those things rally if the market can hold up as well. So there's the crypto markets. The one main concern that lingers, however, is looking at the dollar and interest rates. Interest rates on the long end of the curve, the 10-year and out, have definitely come down from their highs. However, as the market has risen a little bit in the first part of the year, interest rates themselves have actually gone up a little bit on the long end of the curve. They sit somewhere in the area of 450, of course, on the Fed funds rate, around 453, but also on the long-term bond rate, the 10-year note is sitting around 357. Knowing these kind of things, we're thinking that the yield inversion still exists. That's the thing that portends a recession. And at the end of the day, if these interest rates start to trickle back up on the long end of the curve, that will be the data that we're looking at that keeps us bearish in the intermediate and long term of the market. which means that our math actually will respond to very similarly to those things, because our math definitely keeps a very close track of interest rates. Another thing we should note, everybody, is credit card debt remains on its highs, but M2, this is a number a lot of people might know. M2 is the actual money that is sitting in brokerage accounts and things like that. M2 has decreased. There's generally been outflows into the market, from the market. And as M2 decreases, that's actually deflationary, which means that inflation is being managed by people pulling their monies out of their brokerage accounts to pay certain kinds of bills. We're also noticing home builds. The time on the market has gone from 17 days on the market nationally all the way up to 35 days, almost double, actually double. So that tells us that the home market, although it has fallen off, is starting to steady in these areas. These are the kind of things that we're looking at. And so we're going to be very interested in Case Shiller that will come out later this month. That information is used by our machine learning to determine future price action. We're also seeing volatility remaining very low. The VIX is sitting, just marginally above 20. So that tells me that when you see things like that we are now, that the surprise in the market is to the upside. And that's why the market has shown that we're short-term bullish. So that will be reflected very shortly, likely very shortly, if the market continues its present action. And right now, since there's very little data coming out for the rest of this week, Thursday and Friday, that tells me that there's a probability we can get into the market maybe as soon as Friday. That being the case, so we'll keep an eye on that. The dollar. I think it's worth noting that the dollar has come way off of its highs and has fallen literally down to historical averages. However, these averages are sharply sloping up. So I think we are at an inflection point on many currencies, from the British pound to the euro to the yen. And frankly, if the dollar can steady here and hold in where it is currently with the euro and the British pound, it's sitting for British pound, for example, at we're currently sitting at 121 all the way up from 105, and we're sitting at 107 on the euro. If we can stick in these areas, that also filters into our models and also portends for the possibility of not just a short-term move to the higher prices in the US stock market, but also the intermediate term. So, because the dollar will not just reverse course here, it will steady in this area. Should the dollar weaken further, that will definitely create an advancement in the US stock prices. So right now, we are linked in many ways to the rates and the US currency's value against foreign currencies. And right now, those things are pointing north for the stock market. This is a change that's occurred literally over the last 2 weeks. And since this company and your portfolios are data-driven, the data will drive their price action and their investments. And currently, that means to all of you out there with smartfolios, basically of any kind, look for us to re-enter the market, at least in a larger way in the broader market, but in a smaller way in the technology sector. The technology sector has rallied a little bit, but it is still under pain. And there is no real current value that tells us that the technology sector is going to have some big rally from this area. This needs to consolidate. Should this consolidation occur again, that will bode well for short and intermediate prices in the S&P. However, if these prices and the layoffs occur that are expected beginning late February and March, again, that will drive prices, the dollar higher, and that will also drive the stock markets lower. So look for some volatility, folks. I'll summarize with that. We're going to get a little more volatile in here. We will be taking a few positions. Look for those into your portfolio. I think it actually bodes well for the next couple of months. But after that, I think the risk off will come back, and we'll see how it looks sort of mid-February at that time. So a lot of things depend on the short-term information that is coming out over the next 3 weeks. And at the end of the day, I think some of it's going to point to higher prices.
Thanks for that, Kelly. So just to recap what we had last time, you did forecast a new lows for the first quarter. So are you changing your mind on that based on what we saw the first couple of weeks?
I've predicted new lows in the first 6 months of this year. That remains true.
Okay.
But that doesn't mean that we can't have a little rally here in the first 1 to 6 weeks of this year. That doesn't tell me how the quarter will finish.
Right.
I'm not changing my tune. I'm just saying what we're looking at short term tells me we're going to move a little higher. But the forecast for the quarter and the first half of the year is still lower prices. And I
Gotcha.
do feel the lower prices will take us to new lows sometime this year. But right now, the market doesn't see that data. And at the end of the day, the market is always trying to interpret data in a positive way.
Right.
That is the design of the market. So when you are out of the market, like we are, you're always battling the ultimate desire of the market to go higher. And that is the fine point of managing risk, of being, whether it should be on or off, Aaron. And so at the end of the day, we can be long the market and not like it. I'd rather be a nervous long than a confident short.